Okay, let me just make sure everything's working. What's up, beautiful people? We're going to do a little deep dive on OSCR right now. Just give me a second. Okay, let's do it. So we're going to go over OSCR here. Let's do this. So kind of want to do the same thing I did with the HIMSS one. So OSCR Health. If you guys haven't heard me speaking about this one, been speaking about it from 11 to 12. An absolutely great company here. It's not just an insurance company. They have a lot of tech involved with it. But even with that, overall, this is a company that, again, has 3 to 5 times upside in the next 2 years. You can see the major cup and handle we have here in the monthly. It's also on the weekly. It's also on the daily. But you can see how this is set up perfectly. And we had the breakout this week on earnings, which were absolutely phenomenal. Now, I think we get a move to this 23. I think we get a little pullback. I think we hit that 37 all-time high. But let's kind of dive into their earnings recently and talk about their growth, which is absolutely phenomenal. So the earnings that they had on Wednesday morning, the revenue climbed 42% year over year to roughly $3 billion. By the way, their market cap is a $4 billion market cap, and they're producing $3 billion basically a quarter in revenue, which is absolutely insane on how undervalued this company is. Their net income rose to $275 million versus $177 million a year ago. So again, you have a $98 million increase, which represented to a 92-cent per share diluted share of earnings per share. Their operating earnings jumped to $297 million from $185 million. Again, another major increase. And adjusted EBITDA also grew up to $109 million. Their expense ratios were just about the same. And they talked about a little impact that they had. I believe these are going to get lower, which is going to be really good for the company. Bring more free cash flow, obviously increase those earnings, and getting those expense ratios down is going to be key for this company. Again, it's an insurance company, so their expense ratios overall are usually high. Now, so they talked about everything being in line for OSCR for their earnings per share and their revenue growth for the year. And the revenue growth for the year is 23%, is what they were expecting, right around 11.2 to 11.3 billion. Okay. Their EPS growth this year is expected to be 647%. And in quarter one, they already showed that this is very possible. That was their guidance for 2025. And in quarter one, they came out with a bang and showed that this is very possible. Their next 5-year EPS growth is 161%. So we're looking at basically 33% year over year. That is absolutely phenomenal for this company. And then overall, again, talking about that, going into this 2025 year, their guidance for revenue is 11.2 to 11.3 billion. And that could always change. It could always go a little bit higher. It could always go a little bit lower. After quarter one, they put it in line and said they are going to meet or exceed those expectations as well as their EPS expectations. But you're talking about a company that is basically producing 2.75 times in their revenue compared to their market cap. And then you're talking about that same company that is now going to produce basically 10% of that market cap in earnings, in net income. This company is strongly undervalued. This is a company that I've been buying 11, 12, 13, 14. This is a company that I already have 2027 calls leaps on. And I truly believe within the next 1 or 2 years, this is easily over 30 and easily over 37. I think there's a strong possibility that this could hit 47 to 50 by the end of 2026. And that's why